Okay, so today I want to talk about something that's been really popular over the last 2 or 3 years, and that is, should you overpay your mortgage or should you invest? A lot of the stuff you read online really focuses on there being one right answer, where in reality, that just isn't the case because it's completely dependent on your circumstances. In today's video, I'm going to talk you through the things you want to think about when you're making that decision and how that might impact you based on your scenario. But if you're new here, my name's Ben, I'm a qualified financial planner, and my aim is to help as many people as possible gain more clarity and confidence around their financial plan. Okay, so why does paying down your mortgage and making those overpayments feel so good? Because I think for a lot of people, that is their default answer when it comes to whether they should overpay or invest. Now, the first thing to say is that clearly by doing this, you are getting a guaranteed return. Let's say, for example, your interest rate on your mortgage is 4%. You making that overpayment is a guaranteed 4% return on whatever that overpayment is. So let's say over the course of the year, you pay £100 extra towards your mortgage each month. So that's £1,200 over a 12-month period. You've basically guaranteed a 4% return on that £1,200. For you to get a better investment return in the stock market by investing it, you would have to achieve a return above that 4%. I think that's the first thing that people really think about, is that that is a guaranteed return by paying off their mortgage, which is why a lot of people seem to default to that as being the right answer. Now, the second point is the emotional relief people get by reducing their mortgage. And I think, particularly for people in their 30s and 40s, there's this real stigma attached to debt. And I think a lot of that is probably from our parents and their generation in terms of what they experienced with things like the credit crunch and the impact that had. So there is this real, I suppose, symbolism of debt being a really bad thing. So I think for people, being able to focus on their mortgage and reduce that debt is a real emotional benefit to them. And I'll come on to that in a bit more detail later in the video. That is the second point in terms of why paying off your mortgage feels so good. And the third point, I think, is in terms of the future flexibility this provides. So let's say, for example, you're making those overpayments and you can reduce the term of your mortgage from, say, 20 years to 15 years by doing that. What does that extra 5 years then mean? So for some people, it might mean, they've got a bit of extra money each month. They've not got a mortgage to pay for and their kids might be growing up. So it really gives them a bit more flexibility when it comes to their spending in those 5 years in which they're not paying their mortgage. And for some people, it might even mean they can retire earlier, because for most people, their mortgage is their biggest expense each month by quite a long way. So if you're suddenly in a position where by making those overpayments, it means you can retire 5 years earlier, for a lot of people, that is a huge win and it's something they really want to strive for. Okay, now let's move on to what investing gives you that paying down your mortgage doesn't. So the first thing I would say is that while clearly no guarantees a return when it comes to the stock market, generally you would expect there to be higher returns over the long term on the stock market than you would on the interest rate you're paying on your mortgage. So again, let's use that example of a 4% mortgage rate. So as I said, if you're making overpayments on your mortgage, you are guaranteeing that 4% return on whatever the overpayment is. If you're investing, on the other hand, although that return is not guaranteed and is likely to fluctuate from year to year, you would expect that over the course of a 5 or 10 year period, you would achieve a better return on your money than 4%. Now, as I say, it's going to vary quite a lot, but you would typically expect somewhere between maybe 6 to 8% a year on average. It depends on the sort of time frame you're looking at, clearly, but what I would say is over the long term, you would expect a better return on investing than you would by paying down your mortgage. Now, the second thing I would say is that inflation plays a really big factor when it comes to the comparison, because your mortgage rate is not fixed. Clearly, it's fixed for a period of time. And during that time, your mortgage rate is fixed, but your monthly mortgage payment is also fixed. So let's say, for example, you've got a 5-year fixed mortgage rate. You know that the amount you're paying each month is going to be the same month in, month out for those 5 years. What that gives you is that, if your income is increasing, let's say in line with inflation over that 5 years, you know that you're going to be better off each month because that mortgage amount isn't going to change. So your income's increasing in line with inflation and your biggest expense for most people is fixed each month. So that's a real benefit to actually having a mortgage, because it does reduce over time because of inflation and not just the payments you're making. And the third point I would make when it comes to the comparison is that Clearly, if you're overpaying your mortgage, you are locking that money away because it's tied up in the equity in your property. Whereas with investing, you can access that money whenever you want. Now, clearly, when it comes to investing, you need to be looking at that as a longer term investment. So a 3 to 5 year period, I would say, is the very minimum you want to be looking at. I think people forget the, I suppose, accessibility issue when it comes to the two, whether you overpay the mortgage or invest, because if you're making those overpayments, great, you can guarantee that 4% return. The problem you've got with that is that unless you are going to move property at some point, you can't physically access that. And I'll do another video on this in the future because I think this is another area when it comes to retirement that people, I suppose, overlook in a way, because I think there's this real sort of attachment to property, particularly, of a certain generation. The money you've got in that property, you can't access. It's effectively useless to you unless you're going to downsize at some point. So the accessibility of investing versus overpaying is one that you should really, I suppose, give some thought to when you're making that decision. Okay, so now we've looked at the comparison of the two, I suppose, pros and cons of both of those. What do we do to come up with a framework to make a simple decision as to which one you should do? What I would say first is if you're anxious around debt and you've probably got quite a low tolerance or capacity for loss when it comes to investing, you should probably focus on paying down a mortgage because it's going to reduce your stress, you're probably going to sleep better, and it is guaranteeing that return for you. So that's probably going to be a better solution for you in the longer term. Now, on the other hand, if you want to prioritize long-term growth and making sure your money is working as hard for you over the long term as possible, you probably want to be looking at the investing over overpaying. If you've got a relatively low mortgage rate, and for most people, you would expect it to be somewhere between 4 and 5% on the whole, you're probably going to get a better return on investing than that over the long term in an ISA, for example. Now, some people might not fall into either of these camps and think, okay, well, I do want to prioritize the mortgage, but I do have sort of one eye on the future and really wanting to, I suppose, maximize how hard my money's working for me. There is an option where you can do both. And I think, again, this is something that's overlooked because humans typically think very black and white in most cases. And it's almost a, which one do I do? Whereas in reality, you can do both. So let's say you've got an extra £200 a month that you've got to either put towards the mortgage overpayments or invest. You can quite easily put £100 towards the mortgage and invest £100. And that way you're getting best of both worlds because you are reducing the term of your mortgage by making those overpayments and guaranteeing a return on that. But you've also got one eye on the future, and by investing, it does give you that option and opportunity to get better returns than that 4% and really improve the long-term trajectory of your net worth. So to finish, what I would say is that, don't chase the optimal answer because it's going to be different for everyone and it's a very personal decision that you need to make. And ultimately, you need to do the thing that you think is going to give you the most peace of mind and confidence around your long-term financial future. If you read online, invest because it's going to get you the best return. And yeah, don't get me wrong, I've spoken about that in the video, but I think it's just important to actually think about what's important to you and what your goals and objectives are. Because if you can do that and you think, I know I'm really anxious about this mortgage and I really want to get it reduced for X, Y, and Z reasons, that's great. You can do that. It's just about making sure that whatever you're doing is aligned to your goals and I suppose bearing in mind the various points I made in this video. But anyway, hope you've got some value from the video. If you did, please do like the video and subscribe to the channel because I will be making a lot more videos like this in the future. And hopefully I'll see you in the next video.